talk more about this is K. Ganesh, the promoter at Big Basket, Portia Medical, as well as Home Lane. We're also being joined by Rehan Yar, managing partner at Arise Ventures, an early investor in many unicorns, including the likes of Oyo. So Ganesh, I'll begin with you. A year ago, it was a very different time where, we saw everyone being bullish on digital companies, which had network effects. We saw how IPOs brought new investors to the stock markets as well. Since then, NASDAQ stocks down 70 to 80%. The era of free money is behind us. Startups are now stopping to burn cash, increasing their cash runway, looking at the bottom line. The first question for you, Mr. K. Ganesh, is the worst behind us now? Will things only start to get better?
No, it's a tough time for all companies in the stock market, not just new age tech companies. Even the traditional companies are seeing coming off their highs. I don't know whether I can categorically state that the worst is behind us in terms of specific stocks, but the tech companies have raised money, have demanded a certain valuation based on future, what they are going to do and execute in the next 1, 2, 3, 5 years. Because there is no existing EPS or existing profitability or growth in EPS and all of that stuff. Tech companies is and was, when they go to IPO, is about future metrics. The key question which we need to watch for to see whether the stock will appreciate, it will do better, it will go worse, is how are they performing vis-a-vis the projection, vis-a-vis the convergence that they talked about. For example, if you take a food aggregator, what the take rate from restaurants, how are they performing? Unit economics on every order, it was negative. How is it performing? So it is really futuristic based projection, how well the company and the promoter are able to converge towards the projections they promised when they raised money. So that, I think, is the key issue. If they don't converge, the market is going to be very unforgiving. Stocks will go down further. I'm not talking about any specific stock, but if they are able to meet those, the markets will reward it, it will go up. That's point one. Second point separately is, right now there is a flight towards safety, not towards growth stocks. Stock market and new age companies has always been about growth. Right now you see that they are all moving towards sentiments is towards safety. And we have seen that globally too. Companies which are not new age tech companies loss making, but traditional companies which are profit making are down, seriously down. Whether it's Netflix, whether it's Amazon, they all have taken a beating. So let's please see it in that context. If you see HDFC stock, it's 22% down from the high. Titan about 10 days ago was 30% from its 52-week high. Infosys was 30% down from 52-week high. So these are not new age company stocks. And the same is being mirrored in the US. So I think we should distinguish between sentiment towards safety versus growth and new age tech stock that's coming. Having said all that stuff, when you are a new age company, you're a new age promoter going to raise money on the basis of future, please be sure that you're converging towards that number. Otherwise, market is going to be unforgiving. But last point, future in India is really tech. When the market sentiment turns from safety to growth, growth will come only out of tech stocks. And tech is accelerating, whether it is cloud, whether it's software, whether it is electric vehicle or green energy, like Mr. Adani talked about, that's the future.
Tech, there's no denying, is certainly the future. Where there is a winter season, of course, is when there was froth, when most of the funds being raised were being used primarily to what? Give Google and Facebook for ads for customer acquisition, price wars that we saw, which defied all rationality when it came to unit economics. So with that, Rehan Yar, I'd like to come to you. K. Ganesh making a very pertinent point that if you could have a TCS and a Wipro also sitting at a 52-week low, why are you singling out the new age companies? But the new age companies also have a focus, very much a focus on quarter se quarter tak ki life, which the new age companies don't want to do. These traditional companies are also very disciplined when it comes to cash utilization. Have you now started to see a change? Because, You're still seeing the Zomato Blinkit deal go ahead. We've seen the reaction from the stock markets as well.
Yeah. No, I think as Ganesh pointed out, the market sentiment is certainly towards being more conservative and safety, and the market is not rewarding growth. And tech companies all about growth. I mean, this acquisition you just pointed out is about growth, and the market seems to be worried about growth. See, the India tech story really is about growth. It's about increasing digital penetration. It's about new people adopting tech, going into starting with the cities, going to tier 2, tier 3, and now going into rural areas. It's about people starting with e-commerce and now using media, online, and financial services, education, all kinds of things, right? In hardware, about electric vehicles and IoT devices, robots, and all of this is a story which is about growing and tapping into new areas. It requires a certain amount of risk taking to do that. And that's what people bet on, that these are large markets, these companies will come, they will capture those markets. And see, you have to understand one thing, that these companies are all asset light companies. In an asset heavy company, what happens is you acquire the asset, you take it onto your balance sheet, and then you slowly move it to your P&L via depreciation. So let's say over 10 years I depreciated, so I'm only moving 10% to my P&L. Whereas in a tech company, what happens is there is no asset. I'm going and I'm acquiring customers, and the way accounting works is that I have to take that entire cost of acquisition of my customer onto my income statement, or my P&L as it's called, right? And that starts showing these losses. A lot of people can't read it this way, and they find that these are very loss-making companies as compared to traditional companies which have a lot of assets and move it slowly to the income statement. But what I would encourage investors to do is look at metrics like return on equity, where as compared to the amount of equity that you're pumping into the company, what is the bang you're getting for it? In an asset heavy company, that is that much lower. But that's how the market, works.
Sure.
It's taking time, for the market to get sophisticated in these areas as well.
Sure. Ganesh, you know what? I wanted to come back to the point that you were making in your first answer, that it's always the case of some winners emerging and Charles Darwin theory coming to the fore, that the best out of the lot will continue to move forward. Which are the areas do you think can that be in, and how should one evaluate these new age tech companies and try and find out those winners?
Yeah, I think it's a great question. The new age tech companies cannot be evaluated on the traditional metrics that is there. For example, these are aggregators or platforms driven by network effects, virality, whatever jargon that you use. The metrics that you evaluate a platform is very different than traditional companies. From an investor point of view, like Rehan mentioned, you need to have the ability to take the risk. When you are investing in a traditional company, you can touch and feel where the money is going. That means it's going to buy a plant, machinery, asset. It's asset heavy, but at least the asset is there. You can, for whatever it is worth, emotionally, psychologically, you feel happy that they have used your money for this. Whereas in a new age company, they use it for negative unit economics, for burn. Suddenly, after the year is over, that burn is gone and you don't have an asset. It is a weird feeling. So investors need to be able to understand that standard metrics is out of the way. For example, in case of a platform, liquidity, the virality, all these become important metrics. I would strongly encourage and urge for investors, without naming specific stock, to look at the macro factor. If you look at where the money liquidity is going to come in, it is going to come into India. China is looking inward. Europe is very fragmented. US is already capped out. So therefore, huge amount of liquidity in the next 10 years is going to come into India. Now, when it comes into India, it's going to go, when the market sentiment changes, it will change. It will go into tech stocks. It will go into great stocks. So to answer your specific question, things which are driven by cloud, driven by AI/ML platform to cater to consumers in tier 2 cities, large middle class consumers that are there. We have seen how Aadhaar or UPI or fintech companies have done adoption. All of that money is going to come to India and come into these sectors. Personally, I am bullish on anything that you leverage on these cloud AI ML technology to solve basic core problems. Also extremely bullish on electric vehicles. You see the growth of electric vehicles, the way the government is supporting electric vehicles, the kind of subsidies they are giving to promote. And I mean, Rehan and I don't want to name the company. We have an investment in a company that do battery swapping. Okay, right? And the amount of growth they have seen in the last 1 year is phenomenal. These are the areas that will see maximum growth. Wait for the sentiment to change. The money is going to come here. These are the sectors that you're going to see. I also see
Sure.
huge potential in exports.
Right.
Again, government, what they are doing to promote exports is also huge. I
Sure.
think combined with PLI, exports from India, electric vehicles, and using technology and new age models to solve for basic consumers, including tier 2, tier 3 cities, are all great areas to come in. No specific stock recommendation, but this is where really it's going to go. See, look at Paytm.
Sure.
Look at Paytm. Last 2 months, I mean, it has seen a growth of 40 to 50%. That means investors have seen positive money if they invested, and people have invested. No, that's how the stock market works.
No, well, sure, Ganesh, as well as Rehan. Sorry, we'll have to let you go at this point of time, a little short on time, but makes for a very interesting discussion. And as you've already given us a cheat sheet as to which sectors we should, eye for as far as the next leg of growth is concerned in these new age tech companies, we'll continue following that. Thank you so much, gentlemen, for joining us on the show today. Time now to slip into a very short break, but don't go anywhere. A lot of stock-specific ideas lined up for you on the other side.